Hello, thanks for joining us for our quarterly investment perspective review. I'm Aldo Vultaggio, Chief Investment Officer at Capstone Financial Advisors. The following is general commentary on the markets and economy and his opinion. First, a quick market review. In the third quarter, global stock markets continued to climb, with major indexes hitting new records despite higher volatility. Investors shifted their focus away from the mega-cap tech stocks that led earlier in the year gains, rotating into value stocks, small caps, and sectors like utilities and industrials. Even with pullbacks in some big tech names like Nvidia and Microsoft, a broader range of industries helped drive markets higher. Additionally, bond markets rallies as the Federal Reserve began cutting short-term interest rates. Intermediate and longer-term bonds performed especially well, as longer-term rates also declined due to expectations of further rate cuts. International bonds also rallied as central banks like the ECB continued their rate cuts amid cooling inflation and slowing economic growth. As we look ahead, stock market gains are likely to continue, supported by strong consumer spending, steady business investment, and more interest rate cuts from central banks. But with stock valuations relatively high, future returns could be more modest, and there are risks on the horizon, including slowing economic growth, rising geopolitical tensions, and the looming U.S. elections. On the bond side, returns are set to remain strong as interest rates continue to fall. Bonds still offer compelling yields, and further declines in rates could further boost bond values and overall returns. Regardless if the Fed continues to cut rates gradually or aggressively, bonds remain an attractive option for income and diversification. On the economic front, in the third quarter of 2024, the U.S. economy remained steady as the Fed finally began cutting interest rates. Inflation eased and the job market slowed some as the unemployment rate continued trending gradually higher. Despite this, consumer spending stayed strong, keeping the overall economic growth story intact. Concerns over a potential recession have diminished as the Fed shifted to a more accommodative policy. Internationally, markets faced mixed conditions. In Europe, inflation showed signs of cooling and economic activity across the region remained sluggish, prompting the ECB to continue cutting rates in an effort to boost growth. Other major economies like Japan also faced slowing growth, while China implemented aggressive fiscal and monetary measures to stabilize its property market. Looking ahead, U.S. economic growth is likely to remain steady, supported by resilient consumer spending and a still stable labor market. Despite concerns about a potential recession, current economic indicators suggest the risk of an imminent downturn is limited. With inflation easing and the Fed expected to continue cutting rates, the U.S. economy should maintain growth into 2025, barring any major external shocks. Internationally, economic conditions will be shaped by evolving policies. Europe's growth may rely on continued rate cuts, while Japan still faces demographic challenges despite accommodative policies. In China, continued stimulus efforts will aim to stabilize the property market, but eventually it needs to be enough to boost consumer confidence and spending. As the 2024 U.S. elections approach, investors are focused on how the outcomes might affect their portfolios. The election results could lead to policy shifts in taxes, trade, and regulation impacting various sectors. While a tight presidential race could shift the balance of power in Washington, it's important to remember that historically, markets have performed well regardless of which party's in control. Data over nearly a century shows both Democratic and Republican administrations have overseen positive market returns. Moreover, there is no consistent pattern of outperformance based on which party controls the presidency. Congressional control is another factor. A divided Congress might reduce the likelihood of sweeping legislative changes, which could reduce uncertainty for markets, while unified control could lead to more significant policy shifts. Despite these variables, historical data show that market returns have been robust regardless of the political permutations in Washington. Rather, factors such as corporate earnings, innovation, and economic growth ultimately drive long-term market performance. All that said, election cycles often bring increased market volatility due to the uncertainty surrounding potential policy changes. investors tend to be cautious, leading to short-term stock price fluctuations. Media coverage and polling data can also amplify market reactions, but markets typically stabilize once election results become clearer. In conclusion, while elections can increase market volatility, it's important for investors to avoid making drastic portfolio changes based solely on political outcomes. A long-term investment strategy focused on economic and market fundamentals has proven to be a reliable approach regardless of who controls Washington. Our portfolio recommendations are guided by a long-term view, balancing the current stock market recovery with risks of slowing economic growth and the potential for increased market volatility. First, stock market rallies present great opportunities for disciplined investors to rebalance their portfolios by selling higher-priced assets and adding to undervalued areas. We recommend maintaining diversification across sectors, company sizes, while overweighting profitable, cash flow-heavy companies that can withstand economic challenges ahead. Also, real estate and infrastructure securities, which have been undervalued, also offer compelling opportunities as interest rates decline. Finally, high-quality intermediate-term bonds remain a key part of a balanced portfolio strategy, offering both stability and strong yields in an evolving economic and market landscape. This strategic approach aims to capture growth while managing potential risks ahead. Thanks for watching. If you like this video, make sure to subscribe to our channel for more.